The United States in the early 19th century was young but full of ambition. The War of 1812 had ended, leaving the nation proud, confident, and eager to expand. Cities along the eastern seaboard grew rapidly. Rivers, ports, and trade hubs thrived as commerce boomed. Americans were optimistic. They believed prosperity would last forever. Land speculation became a national obsession. People bought farms, plots, and entire tracts of land on credit, confident that property values would always rise. Banks played their part, issuing loans liberally. Paper money circulated widely, sometimes without sufficient gold or silver backing it. Investors, farmers, and merchants borrowed heavily, assuming the economy could support endless expansion. Yet, not everyone shared this optimism. Some bankers and economists warned of danger. Loans were outpacing actual capital. Interest rates were rising. Speculation had begun to exceed reality. Despite these warnings, Americans ignored the risks. By 1819, the bubble burst, triggering the first major financial crisis in the United States. The Panic of 1819 destroyed fortunes, shuttered businesses, and caused widespread suffering. Following the War of 1812, the United States entered the era of good feelings. Politically, there was less partisan conflict under President James Monroe. National pride surged, giving Americans confidence in their democracy and economy. During this era, land speculation skyrocketed. Western lands were in high demand, merchants expanded trade networks, often buying goods on credit, farmers borrowed heavily to expand production, land prices doubled and sometimes tripled within a few years. Speculators believed these trends would continue indefinitely. Yet, this rapid expansion was built on borrowed money and optimistic assumptions rather than real economic growth. Banks played a critical role in fueling the boom. They issued loans aggressively, often without sufficient backing. People bought land, livestock, and goods using credit, creating an illusion of endless prosperity. The Second Bank of the United States, chartered in 1816, aimed to stabilize the national economy. Yet, its expansion of credit contributed to the speculative bubble rather than controlling it. State banks issued paper money widely, often exceeding the gold and silver in their vaults. This allowed investors and farmers to borrow more than they could repay. Speculative investments included land that was undeveloped and far from markets, business ventures without real profits, commodities purchased on credit in hopes of price increases. When the bubble burst, banks began demanding repayment. Borrowers, unable to repay, faced foreclosure and bankruptcy. The fragile financial system collapsed. Before the panic, some Americans foresaw the coming crisis. Economists warned that rapid expansion was unsustainable. Bankers noticed loans far exceeded their reserves. Interest rates were rising, signaling that borrowers might struggle. Despite these warnings, optimism prevailed. Many Americans believed the economy's growth was unstoppable. Speculators ignored reality, confident that prices and profits would continue to rise. This mindset was encouraged by political stability, rapid westward expansion, and a belief in the nation's manifest destiny. The warnings of a financial collapse went unheeded until it was too late. By 1819, the U.S. economy faced a reality check. Banks began demanding repayment of loans. Borrowers, unable to pay, faced foreclosure. State and national banks collapsed. Consequences included factory closures as credit dried up, businesses went bankrupt, farmers lost their land, unemployment surged. Farmers like John Thompson lost their family farms after borrowing heavily on the assumption that land prices would keep rising. Merchants in cities such as Philadelphia faced bankruptcy as their inventories could not be sold. Urban laborers were suddenly unemployed, with no social safety net to support them. Psychologically, the panic shattered confidence. Trust in banks weakened. Many Americans became cautious, avoiding speculative investments for years. Communities that had prospered now had to rebuild slowly. The federal government had limited ability to intervene. State banks attempted to stabilize local economies. Some states issued temporary relief measures, like delayed loan repayments. Congress debated reforms to prevent future collapses, though no central authority existed to control banking consistently. The crisis highlighted flaws in the decentralized banking system. With no central oversight, states and banks acted independently, creating systemic risk. The Panic of 1819 left lasting lessons. The need for central banking oversight became clear. Excessive speculation carries immense risk. Caution and regulation are essential for sustainable growth. These lessons informed later crises, including the Panic of 1837. They also shaped the development of banking regulations and monetary policy. The effects were widespread. Westward expansion slowed temporarily. Attitudes toward credit and speculation became cautious. Farmers and investors learned to avoid overleveraging. The panic reshaped the economy. Banks became more careful in lending. Investors diversified their risks. The nation learned the hard way that optimism without oversight could have devastating consequences. Over time, the economy began to recover. Land values stabilized. Banks adjusted lending policies. Merchants rebuilt businesses. Families slowly recovered from financial losses. While the crisis caused deep pain, it also strengthened the nation's financial understanding. Americans became more aware of the importance of fiscal prudence and regulation. The Panic of 1819 was America's first financial crisis. It destroyed businesses, ruined families, and exposed the weaknesses of early banking systems, yet it also taught enduring lessons. Economic growth must be managed carefully. Banks require oversight. Speculation carries risk. The crisis shaped future policy, prepared Americans for later financial challenges, and remains a reminder that even the most promising economies need regulation and prudence.